Well, the bank run genie is out of the bottle today, folks. The Silicon Valley Bank is shut down by regulators in the biggest bank failure since the global financial crisis. They had $175 billion in deposits, but $151 billion were uninsured by the FDIC, which means they get exactly zero. Although the article from Zero Hedge says that a sizable number of them likely pulled their deposits in the past few days. Now, the uninsured depositors who are left without their funds, they do receive a receivership certificate for the remaining amount of their uninsured funds, which basically means that as the FDIC goes in to sell the assets of the bank, future dividend payments will be made to those depositors if there's anything left. And sadly, the pain is not isolated with the bank. Markets were rattled as well, with the Dow Jones dropping over 1,000 points in 2 days, the NASDAQ being down over 500 points, and bank stocks getting hammered as well, with Bank of America seeing a 10% sell-off in a single day on the news. And then it took another big leg down at the market open today on March 10th. It has since rebounded and settled down a little bit, but this is not great news for the banking sector. So what does this mean for the housing market, and will it have an impact on mortgage rates? And before we take a look at that, if you're enjoying the content so far, I would greatly appreciate it if you consider liking the video and subscribing to the channel if you would like to see more housing market updates. Well, coincidentally, with all the madness that we're seeing unfold in the markets here, the 10-year Treasury yield took a nosedive today as well, with a rather unprecedented move falling from about 4% to just under 3.7%. And mortgage rates tend to track the 10-year yield in rather lockstep fashion. So if the yield goes up, we generally see mortgage rates and pricing get worse. And when the yield goes down, rates tend to improve. And as of this recording, the average 30-year fixed conventional mortgage has come down to 6.76%. But even though mortgage rates have fallen, we don't know for sure if or how this will impact the housing market. If mortgage rates continue to fall, we're likely to see a small uptick in buyer demand. However, the market is extremely volatile right now, and the past has taught us that when the risk of recession increases, the risks for a credit crunch increase as well, which means that banks are likely to tighten their lending standards, making it more challenging to secure financing. And they do this by requiring higher minimum credit scores for access to capital. They reduce credit limits on existing credit cards or home equity lines. And then they tighten underwriting guidelines to reduce the risk, which makes it more challenging for potential home buyers to get involved in the market. And the reality is that many of us are aware that households and consumers are already feeling tapped out. We're seeing a significant drawdown in personal savings, combined with higher growth in credit card spending, which is an indication that the consumer is feeling more tapped out. If this continues, the probabilities of a recession increase, and the probabilities of a Fed pivot could increase as well, which could lead the housing market down a similar path like we saw in 2008, where home prices fell at the same time mortgage rates dropped. This, of course, improved affordability and created an opportunity for those that were well positioned. Sadly, this is the type of environment that could impact many American households negatively. So with the volatility we are seeing today, it might be a good time to consider reducing expenses, paying down debts if at all possible, building and maintaining an emergency fund, and finding creative ways to acquire new skills and increase income. That is going to wrap up today's video. If you enjoyed the content and found it useful, please consider liking, subscribing, and sharing. It really helps grow and promote the channel. Thank you so much for watching. We'll see you on the next video. Take care.